Hello there, and welcome to HYCM's webinar on understanding market sentiment. If you could just let me know if you can hear me okay, that would be great. If you could just write a message on the chat or on the questions, just so I can know that you're listening and you can hear me okay, that would be great. Just give folks a minute to speak. Yeah, that's great. That's super. It's really great to be doing this webinar. It's Understanding Market Sentiment. My name is Giles Coughlin, and I'm one of the currency analysts at forexlive.com. This is a subject I'm really passionate about, and really looking forward to sharing it with you during the course of this next hour. Market sentiment is one of those terms that's kind of spoken about a lot, but it isn't always very well understood, and it's something, particularly when you're beginning or starting out as a new trader, it can leave you quite confused actually what market sentiment is. So in this webinar, what we're going to do is we're going to introduce the general concept of market sentiment so we can become familiar with what it actually is. Going to describe it, so by the end of the seminar, by the end of this webinar, you'll have a really good understanding of what market sentiment is. And if someone says to you, what's market sentiment, you're going to be able to answer them pretty simply. And I'm going to help you with that conceptually, to have a way of relating to that really simply and easily. Also, what this webinar is going to do is help you to identify the current sentiment. What we're going to find out during this webinar is that sentiment is something that shifts. So you're going to be able to understand what it is, you're going to be able to define it, and then you're going to understand why it changes, and then understanding how to adapt your trading to suit the current sentiment in the market. That's the general outline of this webinar. That's how we're looking at, if as we're going along, you want to ask a question, just type a question in and it'll be really good to answer that. My apologies for those of you who were at the last webinar. I know someone asked a question, but I wasn't quite familiar with the GoToWebinar control panel, and I was looking under the chat box, not the question box. So if that's you here today and you typed a question, my apologies if I missed it. I will be looking at the question box this session. So if you've got one, just type a question in, and that'd be great to get some interaction. And particularly if there's something you're not sure of or don't understand, don't sit in silence. Just type a question out, and I'll be happy to help. So we'll get on to the seminar now, and there we go. So the first aspect to really understand is what is market sentiment? What is market sentiment? Now, the simple answer as to what market sentiment is it's literally the mood of the market. Market sentiment is the mood of the market. And that definition is a simple one, the mood of the market. So I'm going to help elaborate and explain a little bit more what constitutes a mood. Because when you think of a mood, you tend to think of a person. You don't think of a market. And this was something that I went wrong when I initially started being involved with the markets, because one of the attractions for me as I looked at the markets was the fact that it was impersonal, that the market just did seem to be so unemotional. In reality, the market is an incredibly emotional beast, and it's much more helpful to think about the market in those personal and emotional terms. Now, this concept wasn't introduced by me. Instead, it comes from a very famous investor called Benjamin Graham, and he wrote a book called The Intelligent Investor, which you should be able to see on your screens now. And this book is available on PDF. I could see it for free as a PDF, or you can buy it on Amazon. And this book is really renowned and has a great reputation. And if you look at chapter 8, Benjamin Graham introduces a character to us. And the character that he introduces is somebody called Mr. Market. It's somebody called Mr. Market. And this is Warren Buffett commenting on Mr. Market. Mr. Market is a kind of drunken psycho. Some days he gets very enthused. Some days he gets very depressed. And when he gets really enthused, you sell to him. And if he gets depressed, you buy from him. There's no moral taint attached to that. So the strength of what Benjamin Graham brought to the market, as he described it, was think about the market as a person. Now, this person is very emotional. That's what Warren Buffett is reminding us here. Some days he'll offer you a really good price. Some days he'll offer you a really bad price. He is always there. And if you think about Mr. Market as a business partner, every day Mr. Market will come to you and he will offer you a price every single day of the week. And sometimes that price is really, really wrong. It's maybe very high. And some days the price is really, really low. But no matter how Mr. Market is feeling, and he is an emotional character, sometimes he's wildly optimistic, other times he's deeply pessimistic. And every time he's there, he's giving you an option to trade, to buy, to partner with him. And one of your jobs as a trader and as an investor is to be able to read what is Mr. Market's sentiment or mood today. And what you're trying to do is you're trying to identify his particular mood on each particular day. So why does it actually matter? Why does it actually matter if you can understand the mood of the market? Well, it matters because it's going to help you to identify a price that is good value. You'll be able to identify a price that is overpriced. It's a little bit like this. Like if you think about it in your everyday life, say you want to buy a product. Say, for example, you want to buy a new car. I bought a new car recently for my family, and when I was looking at the car, I was researching the kind of car I wanted. I wanted it to be large enough for the family. I wanted it to be economical for longer journeys. I wanted it to have a good safety record. And then when I'd investigated the sort of car I wanted, I then investigated to see what is the market price for this car. I then looked and I tried to find the best price for the car that I wanted. And you see, it's exactly the same with understanding sentiment. What we're trying to identify is what is the best price that we can enter into the market, what is offering us most value. And that's why it matters to be able to identify market sentiment. Because if we can have a sense of that sentiment, if we can have a sense of what mood the market is in, we can then also identify places of really good value to enter and to join. So now we're going to look at different types of sentiment. I'm just going to check if everyone's got any questions. Please just give me a question, type it into the chat or the question box. I just want to check everyone's got that basic understanding of sentiment. So the one way you want to think about it, just to briefly summarize, think about the market like a person who is subject to different moods. And by correctly reading the market's mood, you can be much more likely to create a profit. If you think about it in the sense of dealing with a person, if you've got a person's mood wrong, a family member or a relative, you might end up accidentally feeling the effect of that person's bad mood. And in a very similar way, if you're unaware of the market's mood or sentiment, then you may end up with a losing trade or being in the wrong position. And the market is a very emotional place, and it's prone to wild mood swings, which can be overly pessimistic or overly optimistic. So correctly reading that sentiment will help you keep in step with the market's present mood. That's a brief summary of sentiment. I hope that's clear. If it isn't clear, just send me a message and I can maybe elaborate on that further. We'll move on now to the different types of sentiment. These are just a few of the most common different types of sentiment that you will get. Sometimes there's a buy the rumor, a sell the fact type of sentiment. Now, this is something that often really catches out beginner traders. And the reason it catches out beginner traders is because, for example, you might have heard recently that the Bank of Canada was expected to raise interest rates. That meeting was out this afternoon, and the Bank of Canada, as predicted, did increase their interest rates. Now, this wasn't quite a buy the rumor, sell the fact scenario, but it does serve to illustrate it, because as soon as the interest rates were increased, the Canadian dollar was bought up, which is what you'd expect when a central bank increases interest rates. The currency is bought up. That's the normal way of things. But you see, because the market was fully expecting this fact, as soon as the Bank of Canada raised interest rates, you saw the price of the US dollar, Canadian dollar drop, which is CAD positive, and it dropped, a substantial amount into a daily support level. And then all the traders took their profit and price retraced up to the sort of pre-release price. So as a beginner trader, you would have seen that and you would have thought, well, hang on, that's interest rates have increased, so therefore the currency should rise. But then hang on, the currency has increased, but then it's immediately reversed back the other way. Oh, I can't understand this. When actually all that's happened is the market has been expecting the Bank of Canada to increase their interest rates for an extended period of time. So that means when it actually happens, it's not a surprise. So if you think about it, all the people who've been expecting the Canadian dollar to appreciate with the increase in interest rates, they've got their positions in, and what they'll finally do is take profit as soon as the price is, as soon as the rate statement is released. They take their profit on the spike, and then price decides what it's going to do. This is a kind of buy the rumor, sell the fact scenario. It's a very, very common sentiment. And it's something to look out for over and over again, because when the market is expecting something, remember with the market, it's always trying to look at the next thing. So the market is not necessarily interested so much in what's happening now. It is, but what I really mean is the market is always trying to pre-understand what is about to happen. So what's of more interest, and the Bank of England is a good example of this in some ways, in that the Bank of England is expected to increase their interest rates now in their August meeting, the 2nd of August. So the pound has been appreciating. Now, this is made a little bit more difficult because of the Brexit difficulties that's been coming into the pound. But without that, there were no Brexit difficulties in the way. The pound would just gradually be appreciating into that 2nd of August meeting. Now, when the 2nd of August meeting happens, and if the Bank of England do increase their interest rates, then you would quite likely have a buy the rumor, sell the fact type of scenario. So that's the sort of situation that you want to be looking at. The next type of sentiment is risk on and risk off in the markets. Risk on and risk off in the markets. This is a little bit easier to understand, and we had a risk off scenario in the markets this morning. The US came out and surprised markets late in the US session last night, and the way they surprised the markets was by stating that they were going to add an extra $200 billion worth of goods onto the tariffs that they were going to be implementing. The US last Friday started their tariffs of $200 billion worth of China goods, and they put a 25% tariff on that amount of goods, equated to over sort of $35 billion worth of tariffs. So, you know, a huge amount of tariffs. And President Trump, at the end of the last US session, said there's going to be a further $200 billion worth of tariffs. And that was, you know, instantly met by the markets as a risk-off scenario. And typically in a risk-off sentiment, you will have the Japanese yen that is being sold off. You will also get the Swiss franc. So you will get the Japanese yen being bought up. You get the Swiss franc being bought up. You will also get the US dollar being bought up. And yesterday, the biggest currency pair that reacted was the Australian dollar Japanese yen pair. And the reason that was so affected is because the Japanese yen was bought up, as you would expect. And so Australian dollar Japanese yen pair fell, but it fell even harder because the Australian dollar is so closely linked to the Chinese economy. So there was a kind of a double whammy there. So the Aussie yen pair was affected particularly badly. And that's a good example of sentiment. So when I came to my desk on this morning and I saw that Aussie yen had sold off heavily, I feel that, you know, the correct currency pair to look to sell for that next session was the Australian dollar Japanese yen pair. And any sort of price retracements, any retracements on the Aussie dollar Japanese yen pair was the correct pair to sell, because you knew that the sentiment was risk off. So that's just one example of using risk on, risk off markets. I'm going to hope to show you some actual examples on the charts on the end of this webinar. So we will get to some actual examples as well. Just trying to introduce some of the different types of sentiment for you to see first off. Right, the next type of sentiment is when you get oversold and overbought markets. Now, one of the scenarios you can see an oversold or an overbought situation is when you look at the commitment of traders reports, because the COT report's released every Friday and it sort of indicates the positions of traders. And sometimes when you see a fundamental shift in monetary policy, I will hope to cover fundamental analysis with you at some stage in the future. So don't worry if you don't quite understand it yet. But when you do see a fundamental shift in monetary policy, that can catch traders unaware, and you can have very quick adjustments in price when you have traders heavily positioned to one side of a trade. And the commitment of traders reports, you have a section which deals specifically with the large speculators. And when you look at the COT report, you can see how many large speculators are positioned to the long or the short side of the different currencies. And when you see a monetary policy shift, you can quickly see who's at the wrong side of the market. So that's the way to use the commitment of trader reports, is look, what was the latest monetary policy shift been, and where are the majority of market participants positioned? That's a sentiment shift that you can take advantage of, and you can quickly see whether something's oversold or overbought. The other way of using it is if you see a lot of traders are, for example, long the euro, and you're just about to approach a really significant and key overhead resistance level. If you look to take, you know that traders will be looking to take profit at that level. So you'll know that all those traders who are long euro are about to take profit at a key level. You can, that's a really sensible place if you wanted to, scalp a short, for instance. So understanding the sentiment has nuances as well. That's just two little nuances that you can use on a day-to-day basis, and it's worth having a look at the Commitment of Traders report, which is out every Friday. The other type of sentiment, something useful to know, is something can't go up on good news. You know, if you have a currency pair and it's being sold off, and then suddenly there's some good news and price seems to rally and then is quickly sold back down, that just tells you that the sentiment for that pair is to keep selling it over and over again. So that's always a good tell. If ever you see a currency that's being either sold off or bought up consistently, let's say there's a currency being sold off, and then there's some good news that enters the market that typically would make it appreciate, but it doesn't. That's a really good indicator that its good price is going to carry on going lower and lower. It's going okay. So that's just an example of some different types of sentiment that you get in the market. Now, the next sort of section of the webinar is how to identify that sentiment. We've covered what sentiment is. We can understand it's the mood of the market. We've also looked at some of the different types of sentiment. But how do you identify that sentiment on a day-to-day basis? Now, I work as a currency analyst for ForexLive.com, and this is essentially what I'm trying to hone into every single day. And my first post for ForexLive.com each morning is exactly on this issue. I'm wanting to identify that sentiment, and once I've identified that sentiment, I'm suggesting sensible places where traders can look to take advantage of that prevailing sentiment. So the way to first of all understand is one of the key aspects to realize concerning sentiment is that it's very different to fundamental analysis. So fundamental analysis revolves around central bank monetary policy, and that tends to produce really long shifts in price movements, influencing the market for days, weeks, and even months. But in contrast, sentiment is something that can be affected by quite a range of different triggers. It's not just monetary policy, and it tends to be mainly short term. And as a general rule, most sentiment lasts from between 1 and 3 market sessions. It's particularly helpful for you to identify if you're intraday trading. The market generally craves and focuses on the freshest news. You know, institutional trading firms invest huge amounts of money in order to get information right up to the minute on a day-to-day basis. And I think the Bloomberg terminal costs $2,000 a month, which is used by almost all the institutional trading firms. I've got a Bloomberg terminal and a Reuters terminal that I have access to on a day-to-day basis, and it's constantly giving you the up-to-date news. So the market is craving those constant headlines, constant news, and it's the new information which has the biggest effect on a market. Okay, it's always the newest, the freshest thing that affects sentiment the most. Tends to last between 1 and 3 market sessions. So that's why you get some announcements, and if the market has been listening to it and hearing it again and again and again, it doesn't react to it. It's only the new sentiment that really moves the market. So the first thing to do to identify the sentiment is at the start of every session, what you should do is you should read a previous session summary of the last 2 sessions. So, for example, say you're coming to your desk at the start of the US session, then read through the highlights for the previous 2 sessions. So read through what has just happened in the London session, and then read through before the London session, what happened in the Asian session. And it's very easy to find these reports, these market summaries. Have a look on the HYCM website, check out the resources that they have there. And when you read a good summary, they will highlight the most significant events which have just happened. And by focusing on the most significant events that have just happened, you'll be able to identify the most relevant market sentiment that is going to be happening for your pair. So, was there a political development that's just happened? Has a Eurozone state just had an election and maybe an anti-European party was just found out to be leading in the polls? Was some inflation data just released? Was it a surprise uptick to the upside that surprised the market? Has some GDP data just been released? What about some manufacturing data, particularly top tier data that surprises the market or goes contrary to what the central bank was expecting or projecting, is going to be really listened to by the markets. And what you want to do is you want to think, well, what's the mood of the market for these particular currency? So let's have a hypothetical example. Let's imagine that we've come to the US session, we've come to our desk, and what we've seen is that in the London session, there was a surprise beat to the upside for the CPI data for the UK. Okay, so the CPI data was a surprise to the upside, it beat expectations, which means because the CPI inflation data has increased, it means that the Bank of England is more likely to increase their interest rates. So that's going to mean that the pound is going to be bought up. Okay, so let's think, we looked at that and thought, oh, okay, this is going to mean for this next session, we can expect the pound to be bought. Now, that's the first part of the puzzle. The second part of the puzzle is, well, what pair do I trade the pound with? Okay, and let's say that we also found out that the euro had one of the countries in the European Union had an election, and the result of the election meant that one of these countries was likely to pull out of the Eurozone. So that would mean that there would be pressure on the euro, and the euro would be being sold in the next session. So by analysing the sentiment, the mood of those two currencies, would see that the mood for the pound is that it should be bought, and the mood for the euro is that it should be sold. So the currency pair that you would look to trade for that next session would be the euro pound currency pair. You'd look to go euro pound short. So by analysing the mood of those currencies, and then by pairing together currencies which have the opposite expectation, you can then use that in order to pick a currency pair that gives you the best chance of a successful outcome. And this is where many traders go wrong, because particularly beginners traders, is they'll look at the chart, or they've maybe looked online, and they've been taught technical analysis. Now, technical analysis is very visual. It's a chart, it has patterns, it's relatively easy to understand, and you can see sort of key technical levels. And so many beginner traders will just try to use technicals to trade the market. Unfortunately, it's very, very difficult for this to be successful longer term. And professional traders use technical analysis, but they use it in conjunction with fundamental and sentimental analysis. So if you don't correctly understand the sentiment, you could be using the wrong place for your technical analysis. Whereas once you've identified the sentiment correctly, so in that euro pound scenario, then you can apply your technicals and your technical analysis to that pair. No problem at all. And that's when the technicals are more likely to work out, because you have the sentiment picture and the technical picture come together. So that's the sort of practice that you want to be getting into. So I'm just going to recap on that. You come to your session and you read the last two session wraps. What was the prevailing sentiment? What had a big impact in the market? It was very, very simple. So for myself, when I came to my desk this morning, It was a very easy sentiment to analyze because you saw that President Trump had increased the range of goods, another $200 billion worth of Chinese goods, which were going to be subject to US tariffs. That meant quickly you could see the Japanese yen was bought and the Australian dollar was sold. That was the obvious currency paired to trade because the Australian dollar is linked to the Chinese economy, and anything that's bad for China is going to have a knock-on effect on Australia. So the yen is always brought up when the market is spooked and is worried and is nervous. The yen is a traditional safe haven country. The way the Japanese have structured their debt mean that it's a very safe and secure place to invest your money. So whenever there's something large or frightening like that, investors put their money quickly into the Japanese yen. So there was a very simple trade to see. The sort of things you want to be looking at is you want to be looking at what time of day is it. So you want to be thinking, okay, if you get a sentiment shift on late on a Friday, you might think that's probably not the best time to necessarily enter into a trade. On a Friday, you're going to get profit taking. You're also going to have the majority of traders who are very reluctant to join the market on that time. So that would be an unwise time to enter into the market. Similarly, if you enter into the market in the Asian session, the ranges are a lot smaller. So if you're trading intraday on the Asian session, you need to have kind of a different strategy. If you're trying to take profit during the Asian session, and you want to have much smaller targets, you want to be aware of the different characteristics of those sessions. You don't want to enter into a trade necessarily in between the start of the US session and the end of the UK session. It's a time when a lot of the UK traders are taking profit, and the market tends to retrace during that time. So check the time of day and then think about what the market should do. What was the market expecting? How much of a surprise is this to the markets? Remember, the greater the surprise, the greater the market is going to move. Okay, let's move on. The next thing to point out is something that seems simple, but it's for some people they can find this harder than it seems. And that means be sure to adapt to changing sentiment. It's very easy to become fixated on one outcome. So say, for example, some positive data has been coming out for the Canadian dollar for some time, and you can quite quickly be fixated on buying the Canadian dollar. And you can sort of get yourself into a frame of mind that just says, I'm bullish on the Canadian dollar. But say then something comes out and it changes that sentiment. Say inflation data comes out and it's actually a really surprise low reading, and the Bank of Canada is going to be changing their perspective. If that comes out, mid-session, or maybe you've been sure that the Canadian dollar is going to appreciate, make sure that you adapt. You need to focus on things that are important and they're knowable. That is your kind of what sort of two watchwords that you should have is how important is this information, and can I know it? And if something's important and something's knowable, you need to pay attention to it, because sometimes some data is released and it's unimportant, or sometimes people speculate or say this might happen or that might happen. Things like that, they're unknowable. They're less important. You might want to have different scenarios in your mind, but generally focus on what's important and what's knowable. And if something important comes up to change sentiment, then just listen to it. Just do what you know to do, and go with where the data is taking you. Focus on what's important, and that would help you. Now we're going to look at some examples of sentiment in the markets. So going to go over to the charts. I'm just going to pull out of this. That's it. Just going to pull out of that and just move to the charts. Okay. There we go. Okay, I'm just going to move my GoToWebinar screen out of the way so I can see you are still looking. Now here's here's an example of what I was talking about earlier about buying the rumor and selling the fact. Now this is the US dollar Canadian dollar pair. Now the Canadian dollar has been increasing and appreciating in the last few days. And the reason the Canadian dollar has been appreciating is that it's been a series of good data has been coming out of Canada. And just a few weeks ago, the market was about 50 or even less than 50% sure that the Canadian Bank of Canada was going to increase interest rates. But the data was so good that people thought actually it's most likely that the Bank of Canada is going to raise interest rates. So as I said, a beginning trader would see this and they would be really confused because the Bank of Canada has increased their interest rates today, but yet price has done the opposite of what we would expect. Now, what you have to remember is all the traders who were expecting the Bank of Canada to increase their interest rates have been selling this days before. Because what people are trying to do is they're trying to see what is the next event, what's the next thing that's going to happen. And obviously this increase in interest rates has been seen for a few days. And let's go over to the HYCM calendar and let's have a look at that. So go to the calendar. I'll just see if I can pop a filter on here to see if I can just, let's just do a filter for Canada. I'm not sure if it's letting me. I think I'll have to try and let's see. Okay, I'll put the filter on some of the key data anyway. And if we look, so here's the rate statement today. You can see that the Bank of Canada has increased the interest rates. Okay. Now, if you looked at last week, let's go back to there. So let's go back to there. So start date, let's start date 1st of June. And let's end date on there. Let's see. Oh no, that's not working. Hang on, bear with me. So start date is on the 1st of June. End date on the 11th of July. Let's see. Right, there we go. Okay, so if we look down this, we start to look at some of the data that was coming out of Canada. There was unemployment rate on the June the 8th, net change employment. Okay, that was a bit of a miss. It wasn't particularly bullish. We'll have a look, keep going down. Okay, we saw some retail sales, a little bit of a miss there in April and May. We had some employment, which was uptick to the upside. And so it's going to be earlier where we got that good data coming out. There we go. So we've got unemployment rate, change in employment. Some retail sales were good. There's the core inflation that's rising. That's a real key indicator. So the core inflation rising in May. The last rate statement was on hold. So there's nothing particular there. Okay, the core, there's a slight miss. I think the key thing was this was actually looking to the Governor Pollard's speeches, because there was a mixed array of data that was coming out, but Pollard's was really focusing on the positives for the economy. So it was really his rates, it was his speeches that led markets to believe he was actually discounting. I remember now there was some negative data he was discounting, and he was sort of saying, you know, this, we're still looking on course to hike rates. So the key thing to take away from that wasn't the clearest example, but the key thing to take away is that actually Pollard's was really positive and was suggesting to the markets that hike rates were relevant and appropriate. So the market was selling the Canadian dollar, was selling the US Canadian dollar pair, that's buying Canadian dollar, into the hike announcement. So then today, when the hike occurs, what we see is that traders, they went down with the spike and they took all their profit at this key daily resistance level. So if you look here, that's your key daily resistance level there. And then as soon as the data was released, you can see the data release here, price shot down and traders took all their profits on this key level. And this is a buy the rumor, sell the fact. So everyone who's been buying the Canadian dollar took their profit there. And then they've stopped and reversed, because if you think about it, there's no other catalyst to really buy the Canadian dollar now. If you see on the screen, the data screen, you'll see that there was a press conference an hour and 15 minutes after the rate decision today. And Pollard's came out and he was pretty upbeat about the economy. He was reminding folks that he's data dependent, that you know, they're going to be taking the data as it comes, one step at a time. So going forward, you know, the Bank of Canada's told us that they're going to be looking at data, and that's going to give us an indication of whether this is you know, a one and done rate hike, whether there's more hikes on the way. But for now, that's a clear sort of buy the rumor, sell the fact kind of trade, as everyone's taken profit on the actual rate announcement. Another good sentiment trade to have a look at is on the pound US dollar. Now, if you notice here on the Sunday open, there was a gap to the upside. And what happened here with this gap to the upside was over the weekend, Theresa May on the Friday of last week took her cabinet away, and she took her cabinet to Chequers, a famous venue, and she managed to get all her cabinet together, and her aim was to unify the government around a third way Brexit plan. She managed to do that. So over the weekend, there was a general lull. So folks were broadly accepting what the government had done. And so when the market opened, it gapped open to the upside, and then the pound appreciated. And the reason the pound's appreciating at the moment is because there's been some excellent data out, manufacturing data out recently, particularly the services PMI, which came out, well, I think last week now, a couple of weeks ago, and no, last week rather. And the services PMI makes up 80% of Great Britain's GDP. So an uptick on the services PMI is really important for the pound. So markets have started to price in, you know, a hike, a rise for the pound, and that's why you've got the pound appreciating against the dollar. But what happened on the Monday is you had the Foreign Secretary Boris Johnson resign, and now this is called the Boris candle. And the reason that was so watched by the markets is because if Boris Johnson resigns, he potentially could offer a leadership threat to the to Theresa May. And with significant ministers leaving, there's much more likelihood of a vote of no confidence being submitted to the Conservative chairman. And I think it's something like a 39 MPs or 49 MPs submit a vote of no confidence. There's a vote within the Conservative Party. So what the market realises, hang on, with Boris Johnson exiting, he resigned. We also had the Brexit minister, David Davis, resign as well. What the market feared was that there would be a leadership challenge on Theresa May. And if there's a leadership challenge on Theresa May, that's political uncertainty, instability, and the market doesn't like uncertainty and instability. So the pound was instantly sold off. So you can see that, in that kind of scenario, what you might want to have, a way you could have dealt with that is you could have drawn a fib retracement tool onto that candle. Because remember what we learned about Mr. Market. Mr. Market will offer you a price any time of the day. And sometimes that price doesn't make any sense at all. And he can be wildly pessimistic or wildly optimistic. So in this scenario, you wouldn't have just wanted to jump in here at the bottom of the Boris candle, because it wasn't really a good value place to be. You want to get a better value. So the place to have entered would have been up here, the 61.8 or the 50% retracement, and then you could have played the move back down to the bottom of that range, and then maybe even beyond. You could have done an extension of this leg from there to there. You'd have just put that extension to there and played down to 1.3 100. That's the sort of thing that you would be looking at doing. So that's an example of how you could have played that sentiment. And that's something you're going to be looking at for the next few days. In particularly, look tomorrow, because tomorrow you've got the white paper that is going to be released by the British government, by Theresa May. Now, that white paper is going to set the direction for the pound US dollar pair for the medium term, for sure. And the thing to react is, how does the EU react to the British white paper? Theresa May has got a difficult job trying to balance conflicting views within her own country. She, on the one hand, is trying to satisfy the Brexiteers, which want a hard, deliberate cut from the European Union. On one hand, that's the Brexiteers, hard Brexit it's called. And then there's a group called the Remainers that never wanted us to leave the European Union and want us as far as possible, and if possible, to even return to the European Union. She's trying to satisfy those different competing elements. And there's obviously shades of grey within that, the hard Brexit and the soft Brexit. So she's trying to bring them together. Now, the white paper is what's referred to by Theresa May as a third way. So with Boris Johnson and Davis exiting, what they've literally said is they don't have any confidence and they don't believe in Theresa May's third way. Now, the only reason that the market sold off with Boris Johnson leaving was because he might pose a leadership threat to Theresa May. The resignation in and of itself is not particularly, pound negative. What's pound negative is if Theresa May loses her position. But the next key figure, and this is the sentiment to watch, and it will set the direction, is how does the European Union react to Theresa May's third way? Because if they react positively, then in the back of your mind, you know that positive data has been coming out for the British pound. We've had that services PMI beat to the upside. The expectations of a rate hike for the 2nd of August around 75–80%, then what you could do, you could rapidly expect the pound to appreciate. Okay, and that's the sort of situation you would be in. And if you were, if you suddenly saw that sentimental shift, then you would look to use your technicals. Where's a sensible place to place my stop? Where's a sensible place to put my target? That's the kind of information to look at. Sentiment-wise, look at it tomorrow. Look for the reaction from the EU to the white paper, because that will show you what's going to happen. I want to show you another example of sentiment. I think I can. I'm going to show you the US oil chart. I don't know if I've got it here actually. Let me have a little look. Have I got US oil? I don't think I've got oil here. No, I'll just talk you through the oil chart. What happened with the oil chart was on the 25th of May, you had OPEC announcing that they were going to probably increase their oil production by 1 million barrels per day. So basic supply and demand, if there's going to be more supply in the oil market than there currently is, then obviously the price of oil is going to go down. So, if you're looking at the charts, if you're tuned into the markets, tuned into the sentiment, as soon as you saw OPEC saying, we're going to increase production 1 million barrels per day, what do you think the market did? Well, of course, the market very predictably sold off oil, and it sold off oil into the OPEC meeting. OPEC, they want the market to be stable, so they announced essentially what they're thinking of doing, a week and a half before the actual OPEC meeting. And so in anticipation of that meeting, the oil market was sold off, trying to reach an equilibrium. Yeah, that's a good example. I'll also show you pound yen, another little example of a small sentiment trade. Now this, let me just see where this was. Small sentiment trade. Yeah, okay, here it is. It's just a little one. But I'll show you how this works even on a small basis as well. Let me just see where it is. Pound yen, there we go. Let's see. Be with you in a minute, just trying to train my eye to where that sentiment was, I think up. Seventh, eighth, 8th, 9th, yeah, okay. I think, yeah, sorry, it was on the pound US dollar. Apologies for that, everybody. I'm not used to this chart, so sometimes it does take me by surprise. It's funny how your eyes get trained to one chart, and you can see it on one chart and not on the other. No, I can't see it here, but one illustration I will use on this is if you looked on the 4-hour chart, you can see that was the Boris candle there. And if you look at on the smaller charts, if you look at on the intraday, you can see that that sell-off took 1, 2, 3 hours. So if you're tuned into the markets, and if price was up here and you suddenly you knew what it would happen if Boris did actually leave the cabinet, and the implication it would have, that was an instant quick sell for the pound, and you could have sold it down, for a good sort of 30, 40, 50 plus points from the top. I will show you another chart, and I've got one prepared that I've put up on my guide here. This is a trade that I took on the 14th of. This is my trade I took on the 25th of June. What happened here was the Bank of, this is the Australian New Zealand dollar currency pair. Okay, so I'm trading long Australian dollar, New Zealand dollar. And what happened here was the Bank of New Zealand were about to release their rate statement on the 27th of June. Okay, and I was pretty confident that their rate statement was going to be quite negative. And the reason was, and this is how you start putting things together, is at the end of the fourth quarter, the Royal Bank of New Zealand, they had an inflation miss of 1.6 versus 1.9. And remember, when inflation increases, it means that the bank is much more likely to raise their interest rates. When it decreases, as this instance, it means you're a lot less likely to increase interest rates. And the quarter one, Q1, saw its inflation at the lower end of the band. So coming into this meeting, you're thinking, okay, Q4, CPI miss. Q1, CPI is at the lower end of the band, 1.1. Then 20th of June, just like 5 days before this, the growth was 0.5%, and that was beneath the Royal Bank of New Zealand's forecast for 0.7%. So there was this idea and this expectation that was kind of obvious to everyone who was looking at the data that the GDP growth is going to fall short of what the Bank of New Zealand has projected, and that the inflation is just going to remain subdued, and that interest rates are going to probably remain on hold longer than the Royal Bank of New Zealand or the financial markets currently expect. Okay, so Governor Orr was the new New Zealand governor, and he'd come out and he'd said just prior to this as well, he'd said, you know, we could raise rates, but we could equally cut rates. He says we could go either way on this. And that was interpreted by the market to be a very dovish statement. So the New Zealand dollar looked very weak, and more importantly, I could tell, hang on, when they have their rate statement on the 27th of June, what are they going to say? They're not going to say, oh, the economy's doing really good, because the GDP was a miss, the CPI has been a miss, they've got nothing good to say. So you kind of knew that their rate statement is not going to be great. Whereas the Australian dollar, the Royal Bank of Australia, had a much stronger picture, because although the Aussie had been bearing at this stage the brunt of the US-China trade war, still in its early kind of throes, but yet the Australian's GDP was 3.1%. That's its strongest reading in 2 years. That was for the first quarter. There was, at the time, there was potential for the trade war to be kind of resolved before it happened. That didn't take place, but obviously the market was kind of thinking that could be a potential. And then I saw, look, this is different sentiment shift. There's a different expectation here of these two central banks. So that's when I applied the technicals, and so I placed. I saw that there's an A, B, C, D setup. I'm not going to go into this. It's an Elliott wave theory, but when I saw price just moving up to the upside, I saw that the rate statement was about to come out. This looked like a really, real sensible place to enter a couple of longs. So I entered a couple of longs, and this is when I started to use my technicals. I just placed a stop underneath the swing low on the daily chart, and my initial target was up here, 1.11 region. In the end, I took profit as price just came up to the highs here. It would have gone further. I can't remember if it got exactly there, but that CD projection is just a projection of the AB. I took profit at the highs here because it was month end, and I thought, you know what, I'm just going to take my profit for the month end. I want to finish. I want to finish in a good position for the month. That would have put me in a nice place. Keeps the profit and loss in the right category, and so I took profit up there. So that was one example. that's kind of the end of this sentiment and analysis webinar. Thank you for listening. If you've got any questions, I've got time for some questions now. If you want to quickly send me a question, feel free to shoot it over. Otherwise, let me just tell you that I'm going to be looking at each Monday, 12:30 to 1 o'clock at GMT time. We're going to be looking at the week ahead. We're going to look at what's happening in the next coming week. I'm going to be here on Monday, so please do join me. I'm going to be looking, actually trying to help you guys see these events as they happen and before they happen, so you can be on the right side of the market. Understanding those expectations early is really key to getting into the trades early, and understanding what the market's thinking helps you to see when that changes, or else it can be hard. There's just this huge, you can sometimes feel bombarded with information. Thankfully, not all of it is relevant all the time. Actually, sometimes only a few things are relevant. So that's the idea of these week ahead analysis, is we'll be looking at the week ahead this Monday, 12:30, 1 o'clock. Really good to see you there. Okay, I've got a question coming. Sanjay, I think I've said that right. How to get reliable past data for pound US dollar. I would either try TradeView, Sanjay, or speak to your broker, maybe even speak to any of the guys at HYCM, see if they can give you some advice on that. Yeah, that's the best I can do, I'm afraid, for you on that, Sanjay. The next webinar is drawing support and resistance, which is going to be this time next week on Wednesday. And what I'm going to be looking at on this webinar is how to correctly draw support and resistance levels. It's something that people get wrong, and they have a fixed way of seeing it. So I'm going to help you not only draw support and resistance levels, but I'm also going to help you how you can use support and resistance for entries, for exits, and for targets. It's probably the most widely followed aspect of technical analysis. So that's why it's important to kind of get right and get a good grasp of. That is probably the single most followed technical analysis that there is. It's very simple, and once you've got it right and you've got a good sense of it, it's going to help you to know how to profit and trade and entry and exit your trades in the right area. Okay, well, thank you very much all for listening. That's the end of our seminar. I'll wait a minute for another question. Apart from that, I hope you have a good week, and I hope to see some of you on our Monday seminar and our Wednesday seminar, 5 to 6 GMT. Thanks, guys. Have a great week, and thank you for attending. Okay, that's super. There weren't any other further questions. Have a good night, guys. Bye.